Good afternoon. My name is Kim Schoenholtz, and I'm delighted to welcome you to today's chat with Dr. Isabel Schnabel, member of the ECB Executive Board. The host of today's program is the Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as students and alumni. Today's session will last 1 hour. It will begin with brief stage-setting remarks by Dr. Schnabel, followed by Q&A. We'll finish by 2 p.m. For the Q&A portion, please enter your questions through the Q&A mechanism in Zoom. Since we already have received many questions from students and faculty, I will limit repetition by grouping similar questions together. Please note that anonymous questions are not permitted. Let me now briefly introduce our distinguished guest. Dr. Isabel Schnabel was appointed in 2019 to an 8-year term at the ECB Executive Board. At the ECB, she's responsible for the central bank's market operations, as well as for research and statistics. She also is a professor of financial economics on leave at the University of Bonn, as well as a research fellow at the Center for Economic Policy Research. Dr. Schnabel has enjoyed a distinguished career, both in the academy and as a policy advisor. She has served as a member of the German Council of Economic Experts, as vice chair of the Advisory Scientific Committee of the European Systemic Risk Board, and as chair of the Advisory Board of BaFin, Germany's financial supervisory authority. Dr. Schnabel has published widely in leading economic journals. Her research focuses on banking stability and regulation, as well as international finance and economic history, including financial crises, integration, and capital flows. She received her doctorate from the University of Mannheim in 2003. Please join me now in welcoming Dr. Schnabel, at least virtually, to Stern. And I'm going to turn over to Dr. Schnabel for her opening remarks. Thank you very much.
Thank you so much, Kim, for your kind introduction. Welcome, everybody. So let me try to share my screen. So now I don't see the slides. So where are they? So I hope you can see my slides. Very good. So thank you very much. It's such a pleasure to be here today. I would like to give you in the next 10 or so minutes a Euro area perspective of our monetary policy response to the pandemic. And let me mention that a longer version of this speech and an extended slide deck can be found on the ECB's website. So for more than a year now, central banks worldwide have been tackling the fallout from the coronavirus crisis with unprecedented measures. The first phase of the crisis caused severe dislocations in global financial markets. Liquidity dried up and asset prices plunged, causing a broad-based flight to the safest assets in what became known as a dash for cash. By offering to purchase large amounts of securities, central banks succeeded in restoring orderly trading conditions. In the Euro area, we established the Pandemic Emergency Purchase Program, or in short, the PEP, under which we bought assets worth more than 200 billion euro over a period of just 2 months. The PEP immediately instilled confidence in financial markets and prevented the health crisis from turning into a full-blown financial crisis. However, restoring financial market stability did not remove the risks to our primary mandate of price stability. As the rise in infection numbers in Europe began to accelerate again after the summer, the economic and inflation outlook in the Euro area deteriorated notably. Just when the outlook was at its darkest, news of the imminent arrival of multiple vaccines brought the long-awaited light at the end of the tunnel. The sources of uncertainty then shifted from whether the crisis can be contained to when we can expect a return to normality. The December staff macroeconomic projections suggested that this path could still be long and bumpy. Consumer price inflation was projected to reach no more than 1.4% in 2023, well short of our medium-term aim of below but close to 2%. Further decisive monetary policy support was needed in order to offset the effect of the pandemic on the projected path of inflation, in line with our mandate. The question facing the ECB's Governing Council at its meeting on the 10th of December 2020 was how to best provide this support. Our policy response needed to take two factors into account. One was the already highly favorable level of financing conditions. The chart on the left of my first slide shows that the nominal euro area GDP weighted yield curve stood at its lowest ever recorded level, deep in negative territory. The chart on the right illustrates that real long-term expected risk-free interest rates were also close to their lowest ever level. The other factor was that large uncertainty and mobility restrictions meant that a significant part of the economy was unlikely to be able or willing to take advantage of these financing conditions, delaying the effect of monetary accommodation on aggregate demand. The Governing Council responded with a powerful commitment to preserve favorable financing conditions. Two main characteristics distinguish this policy from the way asset purchases had been conducted before. The first is a departure from a policy that attempts to push interest rates even lower. When uncertainty is large and private demand constrained, monetary policy is like pushing on a string. Pushing hard in such circumstances would likely have limited effects. In addition, a growing body of evidence suggests that the potential benefits of pushing rates lower may diminish even when uncertainty fades. As the left chart on my next slide shows, the share of short-term loans for house purchases has fallen visibly in the euro area, as many borrowers have already renegotiated their mortgages to lock in more favorable rates, potentially dampening the sensitivity of credit demand to lower rates. These effects may be amplified if the pass-through of policy rates to bank lending and deposit rates weakens in the vicinity of the effective lower bound. The right-hand side chart shows that although our main policy rate is currently at minus 0.5%, household deposit rates seem to cluster at levels just above 0%. Lowering interest rates further from already very low levels may also come with increasing costs, and a case in point is financial stability risk. Years of monetary stimulus have made asset price valuation highly sensitive to changes in interest rates, and you can see this on my next slide. So the left-hand side chart shows that in the United States, the yield that investors currently earn in excess of that of a 10-year US government bond has fallen measurably in recent months. And the right-hand side chart shows that in the euro area, signs of overvaluation are increasingly visible in real estate markets. Hence, the harder we push today, the larger the potential risks may be for price stability tomorrow. The second characteristic is the way we deliver on our commitment to preserve favorable financing conditions. Rather than absorbing assets at a constant pace, we purchase flexibly according to market conditions. We buy more when financing conditions are becoming less favorable, and we buy less when they are stable or improving. In other words, our pledge to preserve favorable financing conditions shifts the focus from quantities, that is the amount of assets we purchase, towards prices, the conditions at which sovereigns, firms, and households can access credit. How then can this policy be implemented in practice? Let me start by recalling two fundamental principles of monetary policy. One is that it is real interest rates that affect consumption and investment decisions, while nominal interest rates typically have little bearing on the behavior of firms and households. The other principle is that the favorability of financing conditions is a relative concept. The degree of stimulus crucially depends on how real interest rates compare to real equilibrium rates. That is, those rates that are not directly observable, but that are consistent with a stable rate of inflation. Monetary policy is only accommodative if actual real rates fall below these equilibrium rates. Conversely, an increase in real interest rates is not necessarily a sign that financing conditions are becoming less favorable. For example, as the economy recovers, real and nominal long-term rates will gradually rise in tandem with the real equilibrium rate. Monetary policy will not tighten in this case. These considerations distinguish a policy of preserving favorable financing conditions from yield curve control. The latter targets a fixed level of nominal yields with a view to increasing rather than preserving the degree of monetary accommodation. There are, however, instances where rising rates would unduly tighten our policy stance. For example, a rise in the real term premium, the compensation that investors demand for risks related to the future path of real short-term interest rates, could signal growing uncertainty around the monetary policy outlook or indigestion of duration supply. My next slide shows that a rising real term premium was the main reason behind the sharp uptick in bond yields during the 2013 taper tantrum in the United States and in March of last year. These are the panels on the left and in the middle. These types of movements make financing conditions less favorable, as they are not accompanied by a corresponding increase in real equilibrium rates. The panel on the right suggests that this channel seems to have played less of a role in recent weeks in the euro area. But we are conscious that it may well affect financing conditions in the light of high expected debt issuance. A firm commitment to favorable financing conditions therefore requires a certain minimum purchase volume to offset this effect on real interest rates. Rising rates are also a concern if the market is driven by animal spirits, if investors start to price in a strong recovery, albeit one that is still subject to considerable uncertainty, or if rates increase as a result of global spillover effects. Such price dynamics could result in vital policy support being withdrawn prematurely. Preserving favorable financing conditions therefore puts the drivers of changes in financing conditions and their speed of adjustment into the focus of our assessment. We assess changes in market-based financing conditions jointly with the likely future trajectory of the economy, and in particular, the inflation outlook. The Governing Council meetings in which we discuss the quarterly staff projections have an important role here. But this does not limit our flexibility to adjust purchase volumes in the period between meetings. If market conditions require, the pace and composition of purchases can be flexibly adjusted in both directions at any time. Between the December decision and our most recent Governing Council monetary policy meeting on the 11th of March, we saw a rapid increase in global and euro area nominal interest rates. So how should these changes in financing conditions be assessed? The left-hand chart of this slide shows that at the time of our meeting, nominal 10-year OIS rates were up by around 30 basis points, entirely reflecting a rise in the inflation component shown in yellow. These movements should not be seen as reflecting a genuine reappraisal of the expected future path of inflation. As illustrated by the chart on the right, term structure models suggest that much of the recent rise in nominal 10-year OIS rates reflects an increase in term premia, again shown in yellow, which in turn likely reflects a rise in the inflation risk premium. In other words, after a long period in which inflation persistently surprised to the downside, markets no longer exclude the risk that inflation may rise more strongly than previously expected. This debate, as you know, is particularly acute in the United States. Concerns raised by Larry Summers and Olivier Blanchard have made investors and the public attentive to the risk of higher inflation. Yet, rising nominal rates have not been accompanied by a rise in real rates in the euro area, as you can see on the left-hand side in red. On the left-hand chart of my next slide shows that real rates up to a maturity of 5 years have actually continued to reach new historical lows in recent weeks. The stability of real interest rates is likely to have reflected a combination of two factors. First, the PAP's calendar-based forward guidance promising net asset purchases until at least March 2022 has allayed fears of early tapering in the euro area. Second, the near-term growth outlook for the euro area remains highly uncertain. Vaccination campaigns are progressing slowly, much more slowly than in the US, Infection numbers are rising and containment measures are stricter than in other parts of the world. This interpretation is consistent with the picture painted by the latest ECB staff macroeconomic projections, which foresee an economic and inflation outlook that is largely unchanged from the December 2020 projections. In view of prevailing downside risks, in particular in the near term, the speed of adjustment of nominal yields was considered to pose a threat to the recovery. The risk of an overly abrupt and premature withdrawal of vital policy support was corroborated by model-based evidence shown on the right-hand side of this slide, which suggests that a significant part of the rise in 10-year OIS rates in the euro area reflected global spillovers. Against this backdrop, the Governing Council announced that we would significantly step up purchases under the PEP in the second quarter. So let me conclude. Preserving favorable financing conditions is a powerful policy response to the challenges that we are currently facing. It is a strong commitment to protect an exceptional degree of policy accommodation for as long as needed. This commitment is underpinned by a purchase envelope that is unprecedented in the history of the ECB. We will continue to deploy this envelope resolutely and efficiently, guided by our commitment to price stability. We will flexibly adjust our purchases over time and across asset classes and jurisdictions in a way that ensures favorable financing conditions for the entire economy and paves the path to recovery. So let me stop here. Thank you very much for your attention.
Thank you, Professor Schnabel, for those wonderful stage-setting remarks. I look forward to beginning our chat now. So you mentioned that inflation is still below the target of the ECB. And I'm wondering, over the past decade, why it's proven so difficult to raise inflation or inflation expectations in the euro area.
Yes, Kim, that's a very good question. And I think there are actually different forces at work. So for one, of course, we had several severe crises which had a disinflationary effect, so which depressed demand. We had the global financial crisis, which basically hit the entire world. But then in addition, in the euro area, we had the euro area sovereign debt crisis, which was again putting a disinflationary pressure on the euro area. However, we should be aware of the fact that in addition to those shocks, there are a number of structural factors that have been with us for quite some time. I mean, related to all these more longer term global trends, so globalization, the reduction in productivity growth, demographic effects, which have added a kind of disinflationary pressure. And so I would say it's a combination of these two things. And actually, I mean, we are not entirely alone with this problem. And so other countries are facing the same issue, partly at different levels. But I think it's not a purely European thing.
Great. Taking a step back and just looking at cyclical issues, how should European or Euro area countries balance the objectives of containing COVID and promoting economic growth?
Yes, so that's, of course, a very important issue at the moment. I mean, I would say there is basically no conflict. So the two go hand in hand. And I mean, I think what is holding back growth is basically the virus. And so we need to contain the virus in order to make progress on the growth front. And I mean, the response to the virus, of course, has to be targeted. And I think this is something that we have learned over the past year. So in the euro area, and I guess elsewhere as well, the response to the first wave of the virus was much less targeted than to the second wave. And we can actually see that in the growth numbers. So the effect of the second wave was actually less severe because there was a certain degree of adaptation, there was a degree of learning. So we basically learned to live better with the containment measures. And but in the end, I think what we need is to speed up vaccination. As you know, Europe is lagging behind a bit. I mean, we are now seeing a certain acceleration in the speed of vaccination, but of course, this will be key to the recovery.
Great. So turning to slightly longer term issues, the ECB is currently engaged in a strategic policy review. I'm wondering if you could tell us about the focus of the review and what may come out of that.
Yeah, so as you may imagine, I could talk for hours about this review, and I mean that tells you something. So actually, I mean you have to remember that the ECB conducted its previous strategy review in 2003. So that's a long time ago, and many things have happened since then. And what this implies is that we have to deal with many things. And I can tell you, we are dealing with almost everything you can imagine that is related to a monetary policy. I mean, of course, there are the obvious issues related to our strategy, like the price stability objective. I mean, the toolkit, which of course has changed enormously since 2003. All these unconventional tools that have been used and that are not so unconventional anymore. And of course, all that was a response to the decrease in the natural real rate in R star. And this has, of course, changed monetary policy completely. But then there are so many other issues that we're dealing with. I mean, I was already mentioning all these structural trends. And these issues, of course, also play an important role in our strategy review. So we are, of course, looking at the driving forces of low inflation. So what has led to the decline in R star? Then there are these, I mean, one issue that is, as you know, very dear to our heart is the topic of climate change. I'm sure there will be a question on climate change later on, but this is certainly something that we've never dealt with before. So here we are really starting something entirely new. So this is a very exciting discussion. Another discussion, which is very much related to the macroeconomic discussions that we have had over the past decades, I could also say, even say, is the interaction of monetary policy with fiscal policy, right? This is, of course, one of the very interesting issues, and I find it quite interesting how the perspective has changed. I mean, in academia, but then, I mean, this has really also spilled over to the policy world and also to the public perception, even though that process is probably a bit slower. But this raises interesting new issues. And so in the end, I mean, we are, I forgot one topic, which is also very important, well, which is communication. I mean, this is something that is quite exciting. I mean, of course, we have thought a lot about central bank communication, but when we were doing that, we were always talking about communication with markets. So with very sophisticated investors or central bank watchers and so on. But what is new now is that we are thinking about communicating with the general public. And just as the Fed, the ECB is also running these listening events. And that is actually quite interesting to see because, I mean, we have to be aware of the fact that that many people don't really understand what we are doing. I mean, monetary policy is very complicated. And then we are, of course, confronted with demands that we cannot fulfill. So people are asking questions about minimum wages. And of course, that's nothing for the ECB to decide. But of course, they're also asking questions, let's say, about house prices and climate change, which are maybe a bit closer to what we're actually also dealing with. And I mean, the difficult issue, I think, is that we are, of course, bound by our mandate. And the mandate is, of course, I mean, it has to be limited because we are no elected officials. And so, I mean, in a sense, we are bound to disappoint expectations at some point. And this makes communication quite complicated, I would say. And therefore, we have a particular work stream on communication, which I actually find quite important. Oh, by the way, we talk about, of course, I mean, there are so many work streams, I tend to forget some of them, but financial stability, of course, is another one that is very important. I mentioned this topic a bit also in my introductory remarks, but you can see, I mean, there is really a huge spectrum of topics. And I must say, sometimes I feel a bit bad because, I mean, we're in the middle of a pandemic and our staff is already, I would say, overburdened due to all the work related to the pandemic. But now on top, we have all this work going on in the strategy review. So this is quite challenging.
But it's setting a great standard for central bank reviewing itself and trying to improve. So you mentioned that it's taken nearly 20 years for the ECB to come back to a review. It's worth keeping in mind that the Fed began its first review in a 100-year history only a couple of years ago. So you're ahead of the game. You mentioned two things in your discussion of strategic review that I'd like to come back to. One is climate change. Mentioned it twice. So I understand the ECB recently set up a climate change center. And I'm just wondering what should be the proper role of a central bank in promoting policy that addresses climate risk?
Yes, so that is actually what we are discussing in the strategy review. And by the way, I mean, it's just yesterday, the network for greening the financial system, which is this network of central banks and supervisors, including now the Federal Reserve, have published a report on the role of monetary policy for the greening of the economy. So we're not the only ones, but actually this is quite a general trend that central banks are asking themselves what they can do. And the question is, why are they doing that? And I think the reason is that, I mean, climate change is probably the biggest challenge that humankind is facing. And so at the same time, it has this feature of irreversibility. And therefore, there is this sense of urgency that all policymakers have to ask themselves what they can do, how they can contribute. And as I said before, of course, the ECB, as any other central bank, is bound by its mandate. And so we have to explore what we can do within our mandate. And there are quite a few things. And we're also having, by the way, a legal discussion, how to interpret the mandate, because that's not always obvious. And there is the view, which I find quite convincing, that we are even obliged to deal with climate change in our activities. And what does that mean? I mean, it can mean many things. And many of those things are not controversial at all, I would say. So it starts with economic analysis. So many of our models do not integrate climate change at all. They don't even look at the energy sector separately or things like that. And so, of course, this is something that has to be done, and everybody agrees to that. Another issue is, and of course, the models help us with that, is how do we assess the risks from climate change? And here we have to distinguish two types of risks: the physical risks from actual disasters, and the transition risks stemming from the policies that are introduced in order to deal with climate change. And you probably remember this fantastic speech by Mark Carney a couple of years ago, where he was talking about the tragedy of the horizon. And at that point, we all said, oh, this is something. And so we have a problem because the consequences of our actions are so far in the future that it's very hard to argue why we should act now. And I think that has changed a bit because actually it has come closer. So the horizon has shortened quite substantially. And so I think this horizon issue is no longer as pressing as it was at that point in time. And so we have to ask ourselves, of course, as a bank supervisor, we have to ask ourselves whether we are capturing climate risks to a sufficient degree. We have to ask ourselves what climate change means for the risks on our balance sheet. Of course, we have to consider that, and that could have an impact on our monetary policy operations. And then we also can ask ourselves whether our actions are in one way or the other introducing biases in a direction that is harmful for climate change or for the climate. So, I mean, we're having this discussion with respect to our asset portfolio, in particular the private bond portfolio, because what the general principle is what is called market neutrality. Is that we basically buy according to market capitalization. However, the fact is that those firms that are more carbon intensive actually tend to issue more bonds. And so by following this principle, which, by the way, is not a legal concept, it's not written anywhere, it's an interpretation. I mean, we're basically introducing a bias in our portfolio towards carbon intensive firms. So this has to be discussed. And there are different views on that. But more generally, I have argued in the past that we have to ask ourselves whether market neutrality is an appropriate concept if markets are not working properly. And when you have externalities, then of course there is market failure. And I mean, this is not to say that we are the ones who should do climate policy. Of course, we are not allowed to do that. That's not within our mandates. That's for governments to do. But I would say that there are many things that we can do and that we should do in order to play a role. By the way, it's not only what we do; it's also what we say. It's our thought leadership which plays a role. So it's also that we can have kind of like a catalyst role when it comes to things like disclosures, for example, which certainly is an important thing because, I mean, how can we, let's say, green financial markets if we don't know what green means and if we don't have the data? And so disclosure and taxonomies are extremely important. And of course, I would hope that at some point, we would actually get to global standards in that respect, because this is, of course, what we need in the end. Climate change is a global topic, and so we need global solutions.
That's great. The other topic you mentioned in talking about the strategic review was fiscal policy and how it's relating to monetary policy. So we're now in a period where public debts are rising pretty rapidly, not just in Europe, but virtually everywhere. What risks does that present for monetary policy?
Yes, so at the moment, it's extremely important that fiscal policy reacts appropriately to the pandemic. So it's actually the pandemic is a situation where fiscal policy is the main instrument to deal with the fallout from this crisis. And so it would be a big mistake at this point in time to argue that expenditures cannot take place because public debt is too high. So actually, I would argue that by spending more at the moment, we could actually reduce public debt ratios in the longer run, because if the money is spent wisely, and this, of course, is very important, then this could have a positive effect on economic growth. It could have a positive effect on our star, and through this channel, actually benefit monetary policy by increasing the space that monetary policy has, because, of course, at the moment, monetary policy is constrained by the lower bound issue. This is an issue for us, and that is an issue that has to be solved by structural policies, by public investment. And I think there is some hope. So what we're seeing in the in the pandemic is that there has been this push for digitalization, and we should use that in order to move forward. I mean, the event that we are holding today would be much more complicated if I had to travel to New York, and so it really has so many advantages. I think there is so much scope for productivity increases. And then, of course, the second big issue is the digital transition. And so if the governments play a very proactive role, but use the money not just for transfers, which of course are also important, but also for public investment, then I think we do not have to worry too much about the higher public debt.
Okay. So you've actually, since we're talking about fiscal policy, I just want to bring something up that you've discussed before. You've said before that the Euro area's fiscal rules, and I'm just quoting, are not binding enough in good times and too restrictive in bad times. So how can you improve the fiscal rules in a way that promotes both long-run sustainability and short-run flexibility?
Yes, so you phrased that very nicely, because this is exactly what we have to achieve. So I mean, of course, it's not for me to decide anyway, right? I mean, but it matters. It matters greatly for a monetary policy that fiscal policy plays an active role also in the area of stabilization, and in particular when monetary policy is at the lower bound, because monetary policy is constrained, and also because fiscal policy is much more effective, because we know that fiscal multipliers are actually much higher in those situations. But we still need a fiscal framework. This is especially true in the euro area, which of course is a very complicated structure. So we have a single monetary policy, but we have independent member states which with their own fiscal policy, and so this fiscal framework is actually important. But what we have learned over the past years is that, so first of all, the framework is far too complex. So there are very few people who really understand what's going on. And the second issue is pro-cyclicality. This is what you mentioned before. And this, of course, really reduces the ability of fiscal policy to play this very important stabilizing role. So in a sense, we do need an anchor, so coming through through a debt ratio, but at the same time, we do need this flexibility over the cycle. I mean, what we had was that this really was very binding in the downturn, not allowing enough spending, but then not forcing the member states to use the good times for consolidation. And there is, I mean, among the academic economists, there is actually a broad consensus that one should move more towards a type of expenditure rule, which could solve many of these issues. But of course, politically, these discussions are very difficult. And but they have to come up, and I think they will come up. And I mean, then one has to see what can be done within the boundaries of the current treaty, because changing the treaty, of course, is very complicated politically. But I think some things can be done within the current framework.
Okay. Well, in that regard, during the pandemic, Europe has actually made unprecedented progress toward fiscal burden sharing. And some people have even called it Europe's Hamiltonian moment. Right. I'm wondering how far you think such burden sharing should go, and whether it can be reconciled with the need for market discipline.
Yeah, so as you know, this discussion was actually very active. I mean, before the pandemic, and this question how this can be reconciled. And I mean, there was this general understanding that actually both are needed, market discipline and burden sharing or risk sharing. I think it's important to understand that, of course, this pandemic is very special. I mean, it hit everybody globally. Some were hit more strongly than others, but that was not due to misbehavior or to moral hazard. It was actually due, for example, in Europe. I mean, what of course matters a great deal is the sectoral composition. I mean, we know that the services sector is affected much more strongly than manufacturing, and especially tourism is affected greatly. And this means that at the beginning of the pandemic, there was actually the fear that this pandemic could lead to a high divergence within the euro area, which, of course, for a single monetary policy is a big problem. And this was especially the case because the countries hit hardest by the pandemic were also those having the most limited fiscal space. And I mean, I'm still very impressed that European governments managed to set up this European fiscal package, which a year earlier, I think, would have been unthinkable. And this was, of course, partly an act of European solidarity, but it was also based on the understanding that individual countries cannot thrive within the euro area if all the others are suffering, because the euro area is now so highly integrated in any respect that actually we are all sitting in the same boat, let's say. And therefore, this package was incredibly important. And the hope could be that this shows that such a facility could also be useful in the longer term. Of course, this program is really a one-off. It's a temporary thing. It's a one-time thing, which will expire after a couple of years. But of course, there will be discussions on whether something like this will be needed more permanently. And this political discussion was always very difficult. And I think whether this will become easier in the future will depend on whether this European package will prove a success or not. And of course, this then again depends very much on how the money is spent. I mean, this, especially the Recovery and Resilience Facility, of course, to a pretty large share is meant to foster potential growth, to foster public investment, and to bring countries back to a sustainable growth path and facilitate all the structural change that will be necessary after the pandemic. And I think if this works well, then I could think that that many countries will see that this was, after all, a very good idea. But of course, there is a risk that it doesn't go well, and I think that would actually be a backlash also for future European integration. But I'm optimistic that it will work out. And well, I mean, Europe has always been moving slowly, but it has always moved forward, and this is what I hope also this time.
Okay, so turning to a different topic that hasn't come up yet. I understand the ECB is studying the possibility of creating a digital currency. And I'm wondering what that would entail. Would that mean that the ECB provides direct retail accounts to residents of the euro area, to people outside the euro area? What would it mean?
Yes, this is, of course, one of the big projects that we are running at the moment. I mean, I should say that we are at the very beginning of this process. So no decision has been taken. And so we are just starting to think about this. And this is, of course, related to the fact that the whole world of money and payments is becoming much more digital. And the question is, so how can we maintain monetary sovereignty in such a digital world? How can we give access to public money also in a digital world? So this is basically the question that we have to answer. And I mean, the idea, of course, is to give access to everybody to the ECB's balance sheet, to central bank money. But how this can be done is still a very open question. I mean, there are many issues that have to be dealt with. One important one, and this also came out in a recent public consultation that we did, is, I mean, the privacy issue. So this is really important. People are very much concerned about that. I mean, of course, we always stress that the digital euro would not be a substitute for cash, but a complement for cash. But still, privacy concerns are very high on the agenda of the general public. And so we have to take that very seriously and have to find solutions for that. The other question is how this interacts with our structure of the financial system. So it could raise financial stability issues. So we have to make sure that we are not kind of accelerating runs from private banks, I mean, to the ECB, because of course this asset will be the safest asset that you can have, and safer even than an insured deposit. And these are difficult issues that have to be dealt with. And then, of course, there is this whole question about technology, which also is very interesting and complicated. So, I mean, we should be aware that this is nothing that is going to happen tomorrow. It's going to take many years until it can be introduced, and it can only be introduced once we are really sure that we know how to do it, and it has to be done properly. So we need a long phase of investigation to see whether it should be done, and if yes, then how it should be done. And we are not there.
Okay. Well, you started talking about the financial system, so I have a few questions I would like to pose about that. We're now in the third decade of the euro area, and yet there really isn't a broad, deep market for, let's say, the most liquid, safe asset in the euro. What are the impediments for creating that kind of a market? I'm thinking of something like in the United States, the comparison would be treasury bills or treasury notes and bonds. Can the ECB address the impediments to this kind of a market?
So let me say first, of course, it would make our life much easier if we had such a safe asset, and therefore the ECB has always argued in favor of such a safe asset. But it's related to the answer I gave you a couple of minutes ago, that of course at the moment, I mean, we have 19 different governments issuing a debt, and there is nothing like a euro area yield curve or something. But of course, this would be desirable. But in the end, this is clearly a political issue, which is very closely related to what we discussed before. And I mean, one could say that the issuance in the context of the Next Generation EU is, of course, and also the SURE program, which is this program related to labor markets, which is very successful, actually. I mean, this is something like a very small start going in that direction. But whether we can continue from there will depend, as I said before, on the success of all these European initiatives at the moment. The ECB itself can do very little. I mean, it's really a political issue. I mean, there are many important governance issues that have to be solved. So, of course, I mean, if you have a debt at European level, in a sense, you also need to have the control at European level. So you need a European governance. And all this has to be discussed. I personally think that this would be a very important step. It would also help to foster the international role of the euro. And so from the viewpoint of the ECB, this is clearly a project that should be very high on the agenda. But it's, of course, part of this broader discussion of European integration, I mean, with respect to fiscal policy, but also with respect to the banking sector, capital markets, and so on.
Well, actually, that leads into the next issue, which is what do you think still needs to be done to promote greater integration of euro area banking and capital markets?
Yeah, so I mean, we should be aware that a lot has been achieved over the past decade. I mean, the banking union is not complete, but it is there. And it has served us very well. So with the single supervisory mechanism, which is located at the ECB, with the single resolution mechanism, which deals with bank resolution. And then, of course, the third pillar, the European Deposit Insurance Scheme, is the one that is still missing. But I must say that I'm actually optimistic that progress will be made at some point. I mean, we have also, I mean, we've seen progress in general in financial integration, but there are certain things which are still missing. So when you think about the banking market, of course, a stronger cross-border consolidation would clearly be desirable. The European banking sector has suffered for quite some time from low profitability, and the pandemic will not make that better. And I mean, one of the reasons for that is that actually the European banking market is pretty crowded. So there are so many banks, and so this consolidation process is progressing very slowly, and in particular, there are a number of hurdles for cross-border consolidation, and this is certainly something that will have to be dealt with. But equally important, of course, is the capital market, and there we have made less progress, I would say. I mean, of course, there are also, I mean, numerous initiatives going on in order to foster capital market integration and also to strengthen market-based financing, because the euro area is still very bank dependent. And this has changed a bit after the global financial crisis. So there has been a certain shift towards market-based finance, but it's going relatively slowly. And an integrated capital market, of course, would help to support this shift towards more market-based finance. But for that, many different steps will be needed. So one very important and complicated issue is insolvency regime. So at the moment, we have 19 different insolvency regimes, which of course then also makes it very complicated on the capital market. And this is something which certainly would have to be dealt with. I mean, the safe asset, of course, would be a crucial part of capital markets union. And then at the moment in the capital markets area, the supervision is still fragmented. So we don't have a European level supervision. I mean, of course, we have ESMA, but it has very limited powers at the moment. And at some point, I think one will have to move to a more centralized European structure, also with respect to supervision of financial markets. And I would say this becomes all the more important with Brexit, because now it becomes much more important to build the capital markets in the euro area. And one point I would like to stress, and this goes back to another question that you raised before, is that I see a very strong complementarity between the topic of green finance and the topic of capital markets union. So I actually think this topic of greening the economy could be used in order to accelerate also capital markets union, because there is now the need for so many new financial products that are sustainable. And I always say it's much easier to build something new than to change existing structures. And given that we have to build this green finance segment anyway, I mean, the best way to do it is, of course, to build it in a European way. And all these initiatives like the taxonomy, for example, or initiatives with respect to disclosure, of course, go in that direction and support that. And I think for Europe, that would be very important. Also to use a bit the, let's say, first mover advantage that we have in that area, because a lot has already been done. And so I think these two topics actually go together quite nicely.
Okay. You mentioned in talking about the advance of banking union, you mentioned the single supervisory mechanism and the European stability mechanism. Back in the peak of the euro area crisis, back in 2011 and 12, we observed a doom loop linking banks and their sovereigns. Has the progress towards banking union eliminated the doom loop, or do we still have to make further progress to get rid of that?
Yes. So actually, the situation now is even more complicated, because we have a third player in the doom, or maybe doom loop is even too negative, but in the loop, let's say, which is corporates. Because now we're actually in a situation that governments have issued large-scale guarantees to the corporate sector, and banks have then granted loans to the firms. And so basically the sovereign bank loop has turned into a sovereign corporate bank loop. So it has become even more complicated. But I don't want to call it doom loop, because in this crisis, this type of loop has actually been quite beneficial. So it has been a virtuous cycle so far. But of course, we have to make sure that it does not turn into a vicious cycle. And I mean, many things have already been done. I mentioned banking union. I mentioned bank resolution, which of course was, for example, important in order to cut at least one of the links between the sovereigns and the banks. There are, of course, others that have not been dealt with, like the problem of sovereign exposures, which is a very controversial one. And which, by the way, is also closely related to the question of the safe asset. Because, I mean, one issue that we had in previous crises is that banks were heavily invested not just in sovereign bonds, but in their domestic sovereign bonds. And of course, if there were a safe asset at European level, it would be much easier to break this part of the doom loop. And so again, the safe asset could help here. But of course, at the same time, we do have to think about whether sovereign exposures have to be regulated in a different way. So the short answer is it has become more complicated because we have another player, and more is to be done.
So with an eye on the clock, I want to ask you a question that relates to our audience, most of whom are students. And I was wondering, since you're a professor, what advice you would be giving to students who are thinking about careers in economic and financial research, or more broadly in finance?
So let me say, I think, but that's of course my personal view, this is one of the most fascinating areas that you can be in. So macro and finance, by the way, also economic history, is of course absolutely fascinating, because so many things are happening which are changing and challenging our views of the world. So I think it's absolutely worthwhile to spend time thinking about this and looking at the data and trying to figure out the mechanisms that are at work. I think if one decides to go into the direction of research, I always told my students that the most important thing is that they should look at the big questions. So they should not look at the tiny detail of something, but they should really ask, what are the most important questions that we are facing? And they should start from there. And then, of course, one has to find a proper research design and so on. But never start with a small question, which then becomes even smaller after some time. But start with a really big, important question that matters for the world and for society. And start from there in order to think about what an interesting research question could be.
Dr. Schnabel, many thanks for this excellent discussion. In a few days, we hope to post the video of today's program on the website of the Stern Center. And for the audience, let me also add, we hope to see you again at the next center event on April 22 at 5 p.m. NYU Stern alum, Dr. Henry Kaufman, will join us to discuss his forthcoming book. And that chat will be followed by a panel of leading experts to discuss Dr. Kaufman's influence on market economics. So once again, Dr. Schnabel, thank you so much. And we are really grateful.
It was such a pleasure to be with you. So thank you to everybody who was listening. It was great fun. Thank you.
Thank you.
Bye-bye.
Bye-bye.